friends, we'll start with the first ratio, the liquidity ratio. Under liquidity ratio, what is liquidity ratio? Liquidity ratios, friends, are calculated to measure the short-term solvency of a business. That is, the firm's ability to meet its current obligations. We will start with the first ratio, that is your current ratio under liquidity ratio. So what is current ratio? Current ratio is nothing but a proportion of current assets to current liabilities. It is also expressed as current ratio is equal to current assets divided by current liabilities. Okay, so we will just do a formula here. If the current assets and current liabilities of a concern are INR 100 lakhs and INR 75 lakhs respectively. So 100 lakhs is your current assets and 75 lakhs is your current liabilities. Then the current ratio is equal to current assets divided by current liabilities. So current ratio is equal to 100 divided by 75. We will get 1.33:1. That means the ideal current ratio preferred by banks is 1.33:1. This is, remember friends, this is the ideal current ratio preferred by banks. For normal industry other than banks, they are 2:1. This is only for applicable for banks. The ideal current ratio is 1.33:1. So what does 1.33:1 indicate? Is a good indication or a moderate indication or a bad indication? So what is the significance? We need to study here. So friends, current ratio. So what current ratio is? Current assets, all your current assets, then your current liabilities. Okay, so in current ratio, it provides it provides a measure of degree to which current assets cover current liabilities. If the excess of current assets over current liabilities provides a measure of safety margin is there available against uncertainty in realization of current assets and your flow of funds, your fund flow. So the ratio should be reasonable. It should neither be very high or very low. It should be reasonable, like 1.33:1 is reasonable and proper, correct. It provides a measure of degree to which a current asset over current liabilities. If the excess current assets over current liabilities are there, it provides a measure of safety margin. That means the funds are available against uncertainty arises in realization of current assets and your fund flow. Okay. So this is a good indication. Next ratio we will study here is your net working capital, also known as your NWC. So what is net working capital, friends? So net working capital is nothing but, what is net working capital? Net working capital, you need your current assets and current liabilities are involved. Exactly. So net working capital is your total amount of all your current assets and your current liabilities. It is used mainly to measure the short-term liquidity of a business and can also be used to obtain a general impression of the company's ability, their company or management's ability to utilize its assets in a proper and efficient manner. It is been used, net working capital. So net working capital is a total amount of all your current assets and your current liabilities, total. It is used to measure the short-term solvency or the short-term liquidity of a business, and it can also be used to obtain a general impression of the how is the ability of a management to utilize its assets in a proper and efficient manner. So to calculate your net working capital, we use a formula here, all your current assets minus your current liabilities. So in current assets, there are many items would be there, like your cash and cash equivalents, your marketable investments, your trade accounts receivable, sundry debtors, all your inventory. These all your current assets less your current liabilities, we will get as net working capital. So net working capital, as per this, the above problem, your current assets is your 100 minus your 75 is your current liabilities, you will get 25 lakhs as your net working capital. So friends, what does this 25 mean, or net working capital 25 lakhs means? If the net working capital figure, listen carefully, if the net working capital figure is substantially positive, it indicates that the amount of short-term funds available from current assets are more than adequate to pay for current liabilities as they come due for payment. Understood? It is a short-term liquidity Okay, short term solvency, short term liquidity. If the amount is positive or substantially positive, it indicates the amount of short term funds are available from current assets with the company. With the company, the funds are available more than the adequate amount to pay the current liabilities as they come due for payment. Suppose conversely, if the figure is substantially negative, then the business may not have sufficient funds available to pay for its current liabilities. That means the business is in danger of bankruptcy. So, in conclusion, the net working capital figure is more informative when you track it on a trend line. In a trend line, when you are tracking it, you can know more about a company's progress or a company how it's performing in the current market. Since this may show you a gradual improvement, might be they show you a gradual improvement if the company is performing well. So friends, the next ratio comes here, acid test ratio, also known as your quick ratio or liquid ratio. This is also coming under the heading of liquidity ratio, your short term solvency. Okay. So acid test, what is acid test or liquid ratio or quick ratio, friends? Okay. So we will just have a short gist. What is it? A quick ratio or a quick assets. Okay. So quick ratio, the formula is quick assets divided by your current liabilities. So what will come under quick assets numerator side? Okay. Quick assets are defined as those assets which are quickly convertible into cash. Like while calculating your quick assets, we exclude your inventories, that is your stock we exclude at the end, and other current assets such as your prepaid expense, your advance tax, etc. from the current assets. Why? Because prepaid expense, we are paying the expense before. Yeah, it has not been occurred yet, but still we are paying. We are assuming might be the expense, this much amount might be expense, so we are assuming it and reserving it. So prepaid expense. Then your advance tax, we are paying before in advance, so these all we will be excluding in your quick assets while computing your quick assets. Then comes your stocks. So all stocks, that means reservations, the buffers you have been reserved, that means this all will be excluded from calculating your quick assets. Okay. Because why we are excluding? Because of the exclusion of non-liquid current assets, it is considered better than the current ratio as a measure of your liquidity position. We can know the company's liquidity position by viewing the quick ratio or liquid ratio or acid test ratio. It is calculated to serve as a supplementary check in the what is the liquidity position of a business, and also it is therefore known as your acid test ratio. Okay, so quick ratio is equal to your quick assets divided by your current liabilities. In quick assets, what is quick assets? Those assets which are quickly convertible into cash. So while calculating your quick assets, we will exclude inventories, prepaid expense, advance tax. Okay, from your current assets. So all your current assets would be there. Only these three would be getting deducted or minus. Then you divided by your current liabilities. So this is the quick ratio. So we will just apply the formula here. Quick ratio, what is quick ratio is equal to your current assets on, I mean your quick assets divided by your quick liabilities or current liabilities. So by seeing the problem, cash INR 75,000, debtors 25,000, inventories 10,000, current liabilities 50,000. So by applying quick ratio here, quick ratio. So what I said, quick assets divided by your current liabilities. So current liabilities denominator 50,000, it's right. Then your numerator side, quick assets. Quick assets, all your current assets, cash should be coming, data should be coming. Inventories, I already specified you in quick assets. We will add all the current assets minus your stock, your inventories. Stock, that is your inventories, prepaid expense, advance tax. In these three inventories have been coming, so we will minus inventory. So total 75 plus 25,000, that is your 1 lakh. 1 lakh, then we will minus this 10,000 as inventory. 1 lakh minus 10,000 is your 90,000. So your quick assets, that is your current assets, is your 90,000 divided by your current liabilities is 50,000. You will get a ratio, quick ratio is equal to 1.8 is to 1. So friends, 1.8, okay, 1.8 is to 1. So your quick assets is 1.8 is to 1. So what does it indicate? Friends, the significance behind quick ratio is this ratio provides you a measure of the capacity of a business, the liquidity position of a business, how much is to meet its short term obligations without any flaw. Okay, normally it is advocated to be safe to have a ratio of 1 is to 1, as unnecessary low ratio will be very risky, and similarly unnecessarily high ratio suggest unnecessarily development or deployment of resources in otherwise less profitable short term investments.